Or I can read it slowly. Hey, there's an idea. Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, PSW, nor its affiliates, nor any of their respective officers, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides education and trading services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any losses you may incur as a result of the information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone. Fantabulous! And what a fun day in the market. Something's actually happening for a change. We dropped 100 points on the Dow. We had a nice dip here on the S&P, and best of all, we had a 10-point drop on the Russell, which is what we played in our morning alert. So I guess we'll talk a little bit about why we make the morning alert and what happens. Also, it's 1 o'clock, so let's take a look at the oil report. We're going to look, because we might make a long play on oil, but we have to see something very important before we do anything else. And that is, what is the real petroleum status? Sorry. We have to see what the no BS number is on the petroleum status report, and you can't find that out until 1 o'clock. Now, you check, it should be till last Sunday, so you check your dates always before you do anything else. August 26th, okay. And now, what actually happened? Here you go. The total build was from 5 to 9.8. So 5.3 to 9.8 is a 4.5 million barrel build. That's kind of in line with what they said. So that means there wasn't such a huge build in other oils. It was big, but it was 1.5 million barrels of other oils built up, not the gigantic 4 million or whatever we've seen before. But we did see a very large increase in crude, 2.3 million barrels built up in crude, and you can see that right here. Gasoline actually had a drawdown of 700,000 barrels. But now, you have to think logically, because you're coming into a holiday weekend, and all these gas stations ahead of a holiday weekend, they can't sell the gas if they don't have it. So ahead of a holiday weekend, the gas stations are going to top off their tanks because they're anticipating, hoping the drivers will come. Also, as a factor, you have to think about the fact that gas prices got cheaper. I don't know if you can tell here. Let's see, gasoline. Yeah, here you go. See, the week before, gas prices were 6 cents more than they were this week. All right, so if you're a gas station owner, your price of gas is down, and 6 cents isn't nothing. 6 cents is like, 3% or whatever on the price of gas. So, or 4%. So the gas prices come down 6 cents, and, no, 3%, sorry. So the gas prices come down 6 cents, which is 3% cheaper than it was last week, and the gas station owner knows that they've been going up and down all summer, so they're kind of inclined to make an order that's going to fill their tank completely, to make sure they're completely topped off into the holiday. And they hope, and they know this happens usually too, they play the game the same way we do. they hope that into the weekend the prices will go up, so they'll be able to buy it for, where is that number? Shoot. Here. No, that's not the number. There. So they're hoping that they'll be, well, this is retail price, so it doesn't make any sense, but they hope they'll be able to buy it for the lower price. Well, that went up. I'm sorry. What was I looking at before? Oh, this is the wrong thing. Anyway, but they hope they'll be able to buy it for the lower price and then sell it for a higher price over the weekend. So they're going to, you know, if you don't have the gas, you don't sell it. There's nothing worse for a gas station than being out of gas. So they're not going to risk that, especially, and you know, the ones that are in the commercial areas where people are on vacation and such. They make damn sure they get as much gas as possible. So when you see a drawdown in gasoline the week ahead of a holiday, that doesn't mean there's any demand. It means that people hope there's going to be demand. Now here, this is where the refineries weren't even ramping up. The refineries ran their utilization at the same. The gasoline production was the same. So they didn't produce more gasoline until the holidays. And why? Because we have a freaking glut. We have a huge, gigantic glut of gasoline. They're still working that down. Last year, there were 214 million barrels this time of year. Now there's 232 million barrels this time of year. Last year, there were 1984. Now there's 2099. There's 100 million more barrels in storage than there were last year. It's an average build of 2 per week. All right, so we have a lot of product in storage still, huge glut, and this is not a sign of demand, okay? The fact that we had some stuff. And also, look, we even ship more gas out. See, that number went up. We went from 1.6 to 1.74. So that's another 700,000 barrels of gasoline was shipped out of the country. And that's fake demand. That's not real demand. We're selling it to other countries. That's not demand in the U.S. There's a lot of that going on. So our refiners are making 10 million barrels. They're shipping out 1.7 million barrels, right? Last year, they were making 9.9 million barrels and shipping out 1.5 million barrels. So they're making 500,000 more barrels per, not 500,000, one thing, it's 9.9. They're making 50,000 more barrels, that's all it is. So they're making, 9.9 would be 10 point, the math is hard. All right, let's go 1.5. So they're making 150,000 more barrels a day, but we're shipping out 230,000 more barrels a day. So we're losing ground. So the consumption in the U.S. isn't going up, it's going down. Because their production level is there. Now, this is kind of a weird thing, because their production is 10.1. The supply is lower than the production. But, you know, these are very small numbers, very small differences, so it's hard to say. But you see what's going on? We're just shipping more gas out of the country. We're not using more gas. And also another thing I noticed is they keep talking about demand, holiday demand. You got to be careful. You read these articles, holiday demand, and the narrative that they've been pushing is the record number of miles driven. Miles driven is not demand for gasoline. Okay, if I've got a car that gets 30 miles a gallon and I drive it 300 miles, I need 10 gallons of gas, right? So if last year I had a car that got 20 miles a gallon and I drove it 250 miles, I would have used 12 and a half gallons of gas. So even though my 30-mile-a-gallon car went 20% further, I drove 20% more miles, and that's not what they're talking about. They're talking about a couple of percent more miles overall. But in other words, even though this year, instead of driving 250 miles, I drove 20% more, I drove 300 miles, my 30-gallon car only used 10 gallons. Last year, my 20-gallon car used 12.5 gallons. You're not even on the same planet in comparison. So I could drive 20% more and use use 20% less, let's say, at the same time. There's this huge spread between a car that gets 20 miles a gallon and 30 miles a gallon. That's what's happening when people are upgrading their cars. So, yeah, somebody who has a 30 mile per gallon car or 40 mile or 50 mile per gallon car these days, somebody with a car that gets huge mileage is going to have a different attitude about their trips. And one of the reasons people are driving further is because it doesn't it's a simple equation. It's cheap to drive. If your budget to drive is $50, you can drive much, much further for $50 than you could last year. The gas was more expensive, and you got worse mileage. Obviously, not everyone gets a new car every year, but you understand the aggregate of people who got new cars. 15 million people got new cars. That's a fact in America, or 17 million people last year. So there's 17 million people who can take much longer trips. And so every year that's going to happen. And so people are more inclined to take a big car trip, especially when you start comparing it. Another thing is you compare it to the cost of airfare. I mean, geez, my kids, it cost us, we had to go to Florida earlier in the summer. Something came up and we had to go down there, and it was short notice, and we had to pay $450 a person to go to Florida from New York, which is crazy. And I thought about driving. I'm like, freaking 20 hours. So I personally don't have the time. But if I had the time, if I was a regular person who could take a Saturday and drive to Florida, or take the Saturday, Sunday, drive to Florida, stay there for a week, and drive back the next Saturday and Sunday, I would make a nice trip out of it for the family, but I don't have that kind of time. I looked at the train. The train is ridiculous also, so there's no point. The train takes longer than driving. It's really bad. So the only way to get to Florida is to fly for us, really. But the point being, though, for $1,500, I'm like, Jesus Christ, it's only 1,000 miles. 1,000 miles is 30 gallons of gas. So it's $60 in gas to drive to Florida, or it's $1,500 to get in a plane. I mean, we could have, if it was a trade-off, if it's a matter of deciding which way to go, I'd rather take the trip, stay in a nice hotel. You can stay in a $300, $400 nice hotel. Who cares? Have a nice lunch, nice dinner. Go the next night, stay in another nice hotel. There's the cost of my gas that I saved. The cost of my airfare that I saved. So they're kind of crazy. I mean, these airfares got really nutty. They used to be. I remember when airfares were at a point where you couldn't justify driving. Where driving, you're like, why would I drive when it only costs $100 to fly? Those are gone. Anyway, so you have to think of all these different factors in the reports, not just this and that. And you have to be careful when they start telling you things like record number of miles driven this year. That doesn't mean crap. Was there a record number of gallons of gas used? And that's absolutely not happening. Nonetheless, I'm sorry, so why were we looking at this in the first place? So nonetheless, though, into the holiday weekend, the hype machine starts up, and people will start buying oil and gas, hopefully, at some point. Right now, though, we're blowing off to the downside. 1325 is where we were hoping to go long, but it looks ugly. And oil broke 45. So there's no particular reason to go long right now. I mean, you don't go long just because, I arbitrarily said this morning, I said, look, if 135 fails, and it did, then the next place you want to look for long is 132.5, and now we're at 132.5. All right, but below this, if this doesn't hold, then 130 is the next place we're going to be looking. It's every 2.5 cents on gasoline to look for a support line. And you see here's 1375 failing, right? Because above 135 is 1375, and here's 1375 failing. And above that, you're at 140. And you see how you have the consolidation wave over there? All right, you have to know these things. If you're going to trade commodities or anything, even indexes, you have to understand where your support and resistance levels are, and not these green lines. I mean the real ones, the ones that actually hold up over time. So back to this. Let's see. No questions at all. Fantastic. I can just babble on then. Great. My favorite thing to do. All right, what was I going to talk about? Oh, yeah, I remember. All right, so this morning, let's start with our morning. This morning we sent out an alert. Not this morning, not that morning. A much more recent Tuesday. So for anybody who's a new member, at the end of the day, here's the article, right? And then we chat. Here's the article. Then after the article, when the market opens, we start chatting. So I posted this article at 8:03, and somebody made comments starting at 8:30 before the market opened. So then during the day, this is me. Anything blue is me. It's kind of blue. So then we chat all day long, and then what happens is at the end of the day, so let's see. So here's 9 p.m. That's the last comment by Jean-Luc. So at the end of the day, the comments finish up here. But then in the morning, I haven't written my new post yet. Or I'm in the process of writing it, and I haven't published it yet anyway. I haven't done it. I haven't written yet. So while I'm doing that, I might make some comments to chat. And I usually, because in part of my preparation every day, I look at the news. And then it occurred to me a long time ago, a couple of years ago, I was like, well, why am I just looking at the news myself and then writing an article? Why don't I share the news that I'm looking at with everybody? Because that factors into my decisions, right? So I tend to sort of like quickly take some notes and share the news while I'm looking at it. So this morning, here's what I was doing in the morning. The Nikkei jammed up. Now I was actually up since 5:30. I start a while before I actually start writing because I like to think of what's important to talk about first. But the Nikkei jumped up to our shorting line, 16.9. PIMCO, and PIMCO was talking about Japan's total debt is 600% of GDP. Now, total debt, I don't think that's a real indicator. They're talking about the total public debt, your total, your obligations for pensions and blah, blah, blah. You know, that's like saying your total debt as a person. Like if somebody looks at your debt right now and they say, well, you know, you're going to die one day, so you're going to need a funeral plot, and you're going to get old, and you'll probably need a heart operation. We're going to factor that in. You know, it gets a little much when they start going into that kind of debt levels. It's like, yes, we have retirement things. We're going to fund them. We know this is coming. You know, and then the rest is based on models where you say, well, you don't have enough, and you may have enough, and they change over time. Debt is debt. So the real number, though, the key number for Japan, they are 250% of their GDP in debt, as in they sold bonds and they sold notes and things like that against their debt, and they absolutely owe that money. It's a fact they owe that. That's debt. You know, for a country, that's debt. You have to at some point either pay it off or default. All the other stuff is fungible. But anyway, it's a stunning number. I mean, you know, even the fact that they can come up with that number. So this is PIMCO saying that. And of course, PIMCO, you know, they got their own skin in the game for these things. But anyway, so we had a good reason to short the Nikkei at 16.9, and it's down to 16.830 at the moment. It's a long-term chart, so you can't really tell. But so here's me, okay? So if I'm indenting it, it means I strongly think it's a play. So here's Nikkei 16.9, watching the dollar at 96. We want to see the dollar go a bit lower if we could. So what happened in the day? So what am I looking at? That's what I want to get down. See this? So this is 6:30 in the morning. Here's 4:30. See if I can make that bigger for you. Okay. So here's 16.9. Now, when I woke up, it was over here, and we were over 16.9. I was like, oh, that's kind of interesting, and I'm watching it for a while, and we came down under 16.9, and then we came back over it, and right here is when I decided I better make a comment to people, because I was like, okay, I like this. I like the fact that we're under that line. I like the fact that we're hugging the 16.9 line, and in the path over the long haul, as you can see here on the daily chart, see this is a 16.9 imaginary. See, they're just under 17. It's been very, very tough for them to get over it. They poked over it a couple of times, but right around this level is where they fail. So that led me to say, whoop, not there. So that's exactly what I was saying here. And I said, look, it's a reliable shorting line. You get big, big drops from this level. You go, you know, look, here's, and again, the fact that we go over 16.9 isn't the point. 16.9 is around where we like to start establishing a short. So from here all the way down here, which is a 1,000-point drop. From here, another 1,000-point drop. From here, another 1,000-point drop. From here, another 1,000-point drop. Here, we got a 500-point drop. So now we're back up here. It's so worth it because you're going to put a stop at like 17,000, right? So you can lose 100 points. So if you stop out at, let's say you stop out at 950 at 50 points, that's $250. That's what I said. If you stop at 16,950, or you make a conviction play to 17,000. That means that you'd go short at 16,9, add another short at 16,950. Then you have two at 925. Then you add two more at 975, and you're four short at 16,950. And if you stop at 17, you're going to lose $1,000. You're going to lose $250 four times, and that's your risk. But four stops from 16,950 back to 16 is a potential 19,000 gain. So your reward, potential reward, in other words, if you did this 20 times, you would have been successful, and I'll show you what. Let's say we did it here, you'd stop out, right? Then it comes back down, but you short it again, and now it works, and you make $19,000. Then you go back, and don't forget the thing we're adding. Then you're up here, and you catch it, and maybe you stop out, but you get back in when it's below 16. You make a little bit of money. We won't even count that. Now it's here. You stop out. You wait for it to get back down to 16. It's a little over on the 17 line here. You're back in at 16.9, and boom, you get this big, huge win. Then you're up here. You don't short when it's going up. You short when it's going down. So here you're shorting at 16.9. And boom, another huge win. Here you can see fail, right? Here you're scaling up at 16.9, fails, but then you come back in, and a big success. Notice how basically for every failure, there's a success going along the line. And if your failure is $1,000 and your success is $19,000, you're going to be in very good shape, right? You have to have a discipline. You have to play with a discipline. You have to set proper stops and have realistic goals. You can't short the Nikkei at 15 and say, I think it's going to 0. Because it hasn't done that. Because you got to look back. The last time it was at 15, it went this way. So just because it looks like it's dying, it runs into a big support line, just like here. It looks like it's dying, and it runs into a big support line. And what's that big support line? That's government intervention, But the fact is the government will intervene. So they do support it when it gets too low. But when it's this high, they don't tend to support it, so it starts drifting back down naturally. All right, so there's that part. So that's why I like the Nikkei short there. It's been very reliable. And we already got out. We took this money. Just because you want it to go to, just because I want it to drop 1,000 points doesn't mean it will. We got this move, we got in, and we got out because it made some nice money. And it bounced. So we get, the other indexes started turning up. We made 1,000 on the Russell per contract. We made a little bit here per contract, and we're done. So where did we end up? Yeah, here. So two contracts on the Russell made $1,900. This is today. And four contracts on the Nikkei made $800. So on these two trades, shorting the Russell and shorting the Nikkei, it's $2,700 for the day. That's a good day. $2,700 a day times what? 200 days is, I don't know, a lot of money. $400,000, $500,000. So if you're running that kind of pace, what are you going to do? What's the problem? You don't have to be greedy. All right, let's see. Downside target for SPX. I think a 10% correction is very likely, and that would be right about 2,000. Could be a lot more. Could be 20. Could be more than 20. But 10, I don't see how we can not correct 10. It's just we're so stupidly overboard. I just said that to who? I don't know. Forbes. It was Forbes yesterday. I forget where it was. Oh wait, I know. Here you go. I can see what other people think. I bet they ask more people than just me. You have to open a Forbes in an incognito window so it doesn't block your ads. If you don't look at their little ad, they get mad at you. Near record highs, but investors are not that optimistic. Oh, that's interesting. Okay. So they surveyed a whole bunch of us, and wow, let's see. So the week ending 8/24. Well, he only asked me yesterday, so I don't know if that's true. So bullish, only 29.4, neutral. So bulls and bears are equal, and other people are neutral at the moment. That's basically the summary of it. Here's what portfolio managers are saying. Oh, God, I'm not reading all this. All right, I only care what I said. Well, let's see what this guy said. The market's been overvalued for some. It's the same thing. The market's been overvalued for some time. We think the stock market is overvalued. That's interesting. He's talking about the Fed. This guy's focused on the Fed. He's talking about valuation. So let's read him. It's dangerous for investors to rely on a single poll, which is why we monitor dozens of indicators and a plethora of market, blah, blah, blah. This guy's selling. I don't sell when I'm talking to these guys. This guy's he's looking for customers. We analyze dozens of indicators, blah, blah, blah. With an overvalued market, sentiment indicators we can expect forward to flat returns at best. I agree with that. Most likely returns will be negative going forward. It's time to take a large amount of chips off the table. Well, I totally agree with this guy, so maybe it's worth looking at all these indicators. I said it's overvalued. The PE ratios are near historic highs, and rates are at historic lows. Okay, so in other words, the PE, the earnings price to earnings ratio of the stock is really, really high. So if something's really, really high, you figure it's going to come down. Now, on the other hand, rates are very, very low. These are two factors that boost the market. High PEs boost the market. Low rates boost the market. So you have rates at a low that they can't go lower, and you have PEs that are high that they could go higher, but the only time they've ever been higher than they are now is in the dot-com bubble. For us to go higher than we are now, we have to enter the dot-com zone when things like Yahoo are being priced at 3,000 times earnings. Now, can people be that stupid again only 20 years later? I guess. People are really stupid. I just refuse to participate if it happens, though. I'll take a freaking year off. I don't care. I don't need this crap. It's just, if things are getting that stupid, I don't even want to be here. So PE ratios are historic highs, rates are historic lows. Higher rates. Now, so what would happen? What if higher rates are going to increase the interest paid by companies, which will hurt the earnings more? So in other words, if the rates go up, the PE ratios will get even higher and worse. Okay, and also, then it's not so cheap to buy back your stock anymore. Now you have to spend much more money to buy back your stock because you can't borrow money for nothing. And also, the higher rates takes money out of the consumer's pockets because they have to pay more interest to whoever they owe money to, and that's lower revenues for the company. So there's nothing good coming of higher rates for the market. Now, fuel prices are currently at 20-year lows, and now, I said that this is wrong. I don't know if I said that to him or what, but he says low oil prices. I should call this guy and tell him to fix it. It's high oil prices would help the energy sector and the financial sector to lend some money. Because obviously now fuel prices are 20-year lows. Unless you think it's going to go much lower, it's going to go up, right? So if it's going to go up, then what's going to happen? Then you're going to have higher oil prices, good for the energy sector, good for the financial sector. But it's a rising cost for everyone else, and it has less money in the pockets of the consumers, less revenues. So it's not net good for the market. Rising oil is not a net positive for the market. It's a net positive for the energy sector. And the energy sector, by the way, is so beaten up now that it's hardly a factor anymore in the market. Employment is nearly full, right? So, we have, 4% unemployment, 5% unemployment, whatever. So, the minimum unemployment you can have is like 3.5%. Below 3.5%, and you're basically forcing people to stay in their jobs at gunpoint. Just normal, people turning over in their jobs. Per year, 1 out of 30 people leaves their job. So that's 3% unemployment at some point. So it's, how many, do you have a job for 30 years? That's the question. No, therefore unemployment rate is 3% naturally. 25 years, that's about right? So 25 years is a long time to drop. The natural unemployment rate is somewhere between 4 and 5%. That's normal turnover. So full employment, when the Fed says full employment, they don't mean 100% employment. They mean a normal rate of turnover in the job market. So if employment is full now, and it is, that means that it can only get less full from here. So unemployment can only go up. That means less people will have money, not more. Now, wages are rising and productivity is not. If wages are rising and productivity is not, and that's because we have full employment, so you have to now take workers that you wouldn't otherwise take because you don't have as much choice as you used to have. So the workers you have to bring in are less productive than the top-notch people you were able to get when there was a lot of unemployment and you had your choice. So therefore productivity goes down while you have to get into a training cycle and get these people up to speed. All that's bad for the net income of the company. Another factor that doesn't go for earnings is that it puts money. All right, so that's another thing that doesn't put money. That it puts money back in consumers' pockets to have full employment. But once you're at full employment, where do you go from there? That's the problem. And now you're impacting revenue, so it almost cancels itself out. Okay, fix another computer. Okay, so. And then these are the main factors that we're looking at in America. This is what we're looking at in the U.S., and that's just the U.S. Now, you know Europe's a mess, and you know that Asia's a mess, so they're much worse than us. And so our best case isn't that great at this point, and everybody else is worse than we are. So that's why we think the valuation is stretched. That, in a nutshell, is my thing. And since it was Forbes, it's funny. I do try to do a better job for Forbes than I do for other people, which I probably shouldn't do. But it's like, I guess they seem more serious. But I want to just very carefully lay out a case and say, look, there's only so many things that could possibly happen, and none of them really point to a higher market from here. All right, so that's where we are. It is scary, though. It's funny. Here's the quote earlier. They pretty much did it word for word. And, see, low oil prices. Damn. So they pretty much did what I said word for word. I think it's horribly scary, though, that that's how reporting works these days. That, like, anything you want to submit is going to get taken. It's very easy to screw around with the markets if you know that whatever you say is going to get repeated by a reporter. All right, so there was thoughts on the move of Taser today. I didn't even know Taser moved today, so let's start with that. Okay, we love Taser, so I hope it went up. Oh, what happened? I have no thought. I wasn't aware of that. They got a little big for their britches, but that's kind of crazy. ETF, Jim Cramer's takeaway. What the hell, Jim Cramer? Smith & Wesson, blah, blah, blah. Does anyone have any idea what happened? What the hell? I said, now these Kramer is my source to find out what happened? It's a sad, sad day if I have to look to listen to Jim Cramer to figure out what's going on. Here's Chipotle. Chipotle, full year, company self-scares. Somebody likes Chipotle, blah, blah, blah. We like Chipotle, too. How high could it run? 600? Okay, I go with that guy. Now, what's his? Taser. Kramer spoke to the Taser founder. Oh, well, that was a bad interview then. Blah, blah, blah. Shares of Taser up 70. Oh, they're up 70% for the year. I mean, geez. Axon is Taser's network. Undisputed momentum. Axon full line of cameras. Smith sees Axon as a platform. That's kind of weird, huh? So Kramer has like a bullish interview with the guy. So that's I don't see any news. That's the only thing I see that happened. Unless you guys know something, that's weird. So the CEO is on mad money, and the stock opens up and drops like a rock. Somebody didn't like something the guy said. But some big fund just got out. That's all. No, I don't think it's a big deal. But somebody didn't like whatever he said. Are you expecting a market drop in September? I'm expecting the market drop in July. I was really expecting one in August. Well, it is August, so here you go. Okay, mission accomplished. I didn't think we'd make it this far. We were doing trying to figure out what went wrong, why the market hasn't dropped yet this week, and we kind of focused on this weekend you have the G20 in China. China's been really boosting and pushing and ignoring bad loans and doing everything they can to prop up their market. Taser ticks lower on report. Family is called on DOJ to investigate. Oh, please. 7% for that? Buy. I mean, that's just ridiculous. Look. I'm sorry. I'm still waiting for there to be a lawsuit that says, can we look at the Taser intraday? I'm waiting for a lawsuit on Taser where somebody gets sued because the cops didn't use a Taser and killed someone with a bullet. That'd be a hell of a lot more logical lawsuit, right? Because, the guy, they say to the cop, okay, well, what was he doing, blah, 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 blah. It tells he was best to Taser. It's like, well, and the lady's like, because he tasered him, he died. It's like, well, if he shot him, he would have died too. You're using the Taser instead of a gun. Now, you could argue that because they have a Taser, now this took a long time. Well, I mean, who knows when this news leaked out. But you could say if he didn't, because he had a Taser, the cop was more inclined to use his weapon. Right? Like Star Trek. You see them in Star Trek. They stun everybody, right? They stun first and ask questions later. They always go, set your phasers to stun. They run around stunning everybody who moves. And then they wake him up and ask him questions. But you do that because you know you're only stunning him, so you don't feel bad. Now, it's interesting. In all the Star Treks I've ever seen, I never saw anybody die from being stunned. But obviously you can die from a taser. You can have a weak heart. You can have different problems that can cause you to die. It's not likely, but it happens. And it's these lawsuits are nonsense. I mean, it's going to happen. And anytime you're having an effect on the stock like that, like see here, I mean, obviously somebody started buying. If that's all it is, I think this is just basically going to test a lower bound for them. That's all. Long term, though, these guys, they're definitely going to 50. So that's how I feel about that one. All right, so where were we? Market drop in September, right? So because of the G20 meeting in China, China doesn't want to be embarrassed by having be in the middle of a big market sell-off when the G20 is coming. So they're pulling out all the stops to keep the market up for now. After the G20, which is next week, really, who knows how fast or how long China's going to keep spending what they're spending to keep the markets up. And our market, of course, also has been held up for the summer. And now all the bigwigs are coming back from the Hamptons, and they're looking at the situation, and they see the same thing I do. And their analysts are going to tell them the same thing I'm telling you guys. It's overpriced. The market's overpriced. Take your money off the table. Take half of it off the table. Make sure you have cash, because at any given time you could wake up and we could be down 10%. Any morning, for any reason. It doesn't take much. Which price level will oil head to? Well, in the fall, this weekend we expect it to go back up. But in the fall, into November, before Thanksgiving, I think it'll bottom back down around 40. There's no demand for oil. We're swimming in oil. There's way, way too much of it. And next year, I'm more bullish. Next year, I think we'll be in the 50s. Because the lack of drilling that's been going on for the last 2 years is finally going to start catching up to us in the spring. But it's going to take a long time, and it's going to be a slow grind. What about gold and silver? Gold and silver will keep going down because the dollar will keep going up. Not these. Currencies. Weekly. Here we go. So, in the winter, now don't forget China fell apart here, so this was the dollar started climbing. In the winter and into the spring, the dollar was around 100 for for a lot of the time, 98 to 100 range. We've gone down for no particularly good reason, frankly, and now we're back up at 96, and we're probably going to come back into this 98 plus range, and I think we're going to test 100 again. So that's going to just grind gold down. Now, if you go back to gold, there we go. Hello? Okay. Here's gold and silver. What happened to them when the dollar was at 100? Oh, dear. Now, that doesn't mean they can go back to 1100, okay? Because the dollar went from 94 to 100, okay? That's up 4%. This is what you have to fix your head on. See, it's very tricky because people get the wrong ideas from chart. The dollar went up 4% and gold dropped 10%. Okay, a 2-to-1 ratio is about correct for gold. So it's not all about the dollar. So while gold dropped 10% against the dollar, it also continued a longer-term uptrend. This longer-term uptrend, okay, and it continued a longer-term uptrend where it bottomed out down here, and now it's coming back and moving forward. And this bounce was from 1800, which it held for a couple of years. So 16 to 1800 range, down to 1200, weak bounce to 1400, weaker bounce. See how? So if you look at a fall from let's say from 1800 to 1200, that's 600 points, right? So the 5% rule says 20% of the drop is going to be your weak bounce. So that's 120 points. 240 points. Oh, look at that. 240 points is a strong bounce. So you have a big fall. You have a strong bounce that fails. Back to your line. Now you have another failure below the strong bounce line. Back to here. Now the next time you're up, you failed the weak bounce line. 120 points up is your weak bounce. This is textbook. Boom. Strong bounce fail. Strong bounce fail. Weak bounce fail means you're going to make new lows. You go back, you make an overshoot of how much? 120 points. The same weak bounce mirrors over here. And now you come back and you make a weak bounce lease, and you actually went through the weak bounce. So now if the weak bounce holds, which is 1320, if the weak bounce consolidates or holds, you're probably in good shape to retest 1440. And if you get over 1440, boom, then you're heading back to test 16. So I think we're basically going to be consolidating around here. Doesn't mean we don't go lower. But we're going to consolidate around here, maybe even test 1200 again, but then we're going to probably make a wave that goes back up and gets us back around 1600. And then it may be between 14 and 16 for a while. So that's my target on gold. But at the moment now, but that's got nothing to do with the dollar, though. That at any given time, the dollar can push you up or down. So at the moment, we think the dollar is going to go up another 4% from here. That means that gold is going to go down another 10%. So now you have to take 140 points or 130 points off. And that means that it would be if the dollar goes up, if we hold 1200 and the dollar's up, it's the same as if we stayed steady. That's how you have to factor it in. Okay, and if we go down back to here, back to 120 points below 1200, so 1080, if we go back to 1080, because the dollar's at 100, I would still be bullish, but I'd say that's the same as if you held 1200. So you got that? Now silver, the same thing. Silver's consolidating under 20, but at the moment, the thing is, I do believe the dollar is going to be coming back first. So I would rather wait for gold to bottom out and see where it ends up. But the fact that gold goes down, you can't look at the gold chart. This is the thing. If you look at the gold chart in isolation, then you have absolutely no idea what's going on. What can I compare that to? It's like so weird to try to compare. It's like, okay, you know what it's like? It's like if you want to measure something, right? And let's say you have one cup that's in milliliters and one cup that's in ounces, and you pour the water from one cup to the other. And today you write down in milliliters it's 840, and tomorrow you write down the ounces is 6. Okay, I have no idea what the conversion is, but you put down 6 ounces, 840, and your graph goes from 6 to 840, and then you randomly start using different measuring cups in milliliters or ounces. And every day the thing goes up and down and up and down and up and down. And then you sit there and start extrapolating from that chart what's causing the amount of water to fluctuate. And the thing is not fluctuating at all. The thing you're measuring it in is changing. And this is what all TA people fail to understand. You're measuring this in dollars. If the dollar changes, you cannot ignore the fact that your measuring tool changed. The value of the dollar is not constant. This is the number one flaw in all TA analysis is they don't take that into account. If you're going to do proper TA, you should be doing it in a constant dollar analysis, and that would take but that would take a lot of pain in the ass calculations, and nobody feels like doing it. And TA is voodoo even if you do that anyway, so nobody does it. It's a joke. Okay, and I know probably most of you guys do it. I'm telling you, it's a joke. TA is garbage. The 5% rule is not TA. The 5% rule is math. It has nothing to do with TA at all. It has to do with the normal motion of a market in any fluid system. It's very much like Fibonacci retracements, which are proven scientific principles. Okay, money is a fluid. Money moves like a liquid in a system, and it's an open, free-moving system. So when money flows in, it backwashes and flows out, and money flows out, it backwashes and flows back in. That's normal. It has nothing to do with TA. It's really tracking the way that systems are designed to move money around. So, did I answer your question? I don't know if I answered the question there. Where were we? Okay. Oh, gold and silver, right. Okay, yeah. No, so much more complicated than it seems to answer that question. Taser. Gold and silver. Will the dollars back up? No, I don't think so. I don't think they're going to hit the lows. I think they've gathered internal strength that will be offset by the dollar, but not completely eradicated by the dollar moving up. So thoughts on ADX? Well, ADX is highly levered to gold, and therefore, if gold goes down, ADX will go down because again, nobody takes into account what's really happening. So ADX will just move whichever way gold moves. And when ADX goes lower, we'll start buying more of it again. Because we love ADX long term. And frankly, the way they cut their costs, I can't imagine why you'd want to own anything else. They've done a phenomenal job cutting their costs on their mines. How do you think the US dollar will get to 100? Because we're tightening and nobody else is. It's not a hard question. If it only went up because the Fed talks it up, if it goes down, it's a fear trade. No, if the Fed tightens rates and nobody else does, then the dollar goes up. That's a really very, very direct relationship. Where is the downside target on Apple for this year, 2017, go long again? Anything around 100, I would certainly start buying Apple. And anything under 100, I would consider a great deal. Where's the downside on BHI? If you expect oil stocks to go down, would you go long at 45? I'm trying to leg into 35. Hey, it's not a good time. It's the wrong time of year. You missed the upside in oil, and now we're going to be heading for a downturn. If you want to buy, November is going to be the time to buy it. If we slump back down to 40, that's not going to last. So when things, whatever things drop down to, we're so far in the money on BHI, we don't really care if it drops 20% right now. But I wouldn't jump in right now for a trade. I would wait for a pullback, and if there's no pullback, then too bad. But frankly, I would wait for a pullback, which is extremely likely. After this weekend, where's the catalyst for oil? You have the big holiday weekend of the summer, Memorial Day. Then it's September. There's no other holiday in September. Then it's October. Halloween's not a driving holiday. Then you have to wait until Thanksgiving for the next excuse to have a holiday oil move. There's no flying things. There's no nothing. And it's not too cold. In fact, frankly, we haven't had a good cold winter in ages. It's not very cold, so there's no fuel, heating, oil demand, or anything else. There's not an excess amount of flying going on. Business travel hasn't kicked up yet too much. There's no special holidays coming up. It's a dead time for oil in any kind of year. So seasonally, this is a terrible quarter to start going bullish on oil. You're coming in at the very top of the market in the summer. It's not a good time to buy. And I love BHI. That's my favorite oil company. So we bet 50 actually. We have some bets for 50, but 45 is what we bet on. I think that 45 line is going to hold, and that's a good it's a good 10% down from where we are now. But I think that 45 line should hold, and it might not though. And you can see on this long-term chart, you see there's some pressure building up there. But long term, I'm not worried about these guys long term. I think this is all going to turn up. I think they're going to be very strong next year. They have $3.5 billion in cash sitting around. That's a lot of money. Oh, do we have 35-55 spread? That's interesting. I'm always surprised by what we have. Seems like a lot. BHI. Oh, no. 55. Yeah, you're right. Okay. It's a little higher than I thought. I have to think about that. Maybe we should adjust it to take it off the table and wait and get back in. I heard in October there will be an SDR introduced. It will cause the U.S. dollar to fill. I really don't know. I doubt it. Look, the dollar is not going to just suddenly fall because somebody introduces a new instrument. It's like all that bogus stuff about China knocking the dollar out and blah, blah, blah. It just doesn't happen. TLT. What's TLT looking at? So annoying. Well, you can see that nobody buying T-bills thinks that the rates are going to go down. IAG, I haven't looked at them, so you have to ask me in chat if we can take a look at them later. I closed my BHI spread last week with reload. That was smart, Latch. He was a smart guy. All right. What was I going to talk about? Oh, yes, right. We're going to look at the trades. Okay. Whoa! Taser go. All right. I don't care about Taser. Gasoline. Oh, well, look, it's holding up around here. It is getting that little formation there that I wanted to see. Wow, look at Nikkei bounce back. Son of a bitch. Because that must mean the dollar did something interesting. The dollar must have popped back up. Yep, back over the 96 line. Oil holding up at 44.50. Wow, 44.50 on the dot. Where's Brent? Do we have Brent on this thing? Brent hit 47, and they're holding up at 47. So you got 47 and 44.50. So their spread widened. Their spread is 250 now. That's pretty wide. I think I like gasoline the best in the weekend. So let's call gasoline along and see how that works out. Let's try that one. So that's going to be an RB. I'm glad I got out of this Nikkei, huh? RB. Doesn't mean it won't go in again, but for now. All right. 132. Oh, come on. Why do I want to buy it? This happens. Come on. All right. Let's put one in. Oh, that feels way too easy. I don't like it. When I make an offer below the price, right, and it fills like instantaneously, that's a little scary because that means that price wasn't really there. Oh, see, and down it goes. It's not a good thing when you get a fill below the price the second you put it in. It means that price wasn't real. All right, so now we have one at 1323. I'd really like to be at 132, but for it to be at 132, it would have to go below 132 now. So let's say that's not realistic. So in reality, if I want to come down to 1322, that means I have to be 18 points below. So that means I have to come in at 13. 0.02. That's not going to happen either. So we'll just take a look. We'll just see what happens for now. I'm not going to get too heavy on this because then I'll lose money for no good reason. Wow, poor Taser. Okay. So here's 1323. So in other words, there's no point. I don't like to buy anything unless it's going to move the needle. Oh, here we go. 132 is where I did want to buy it. 132. Oh, 1322. I'd like to buy one more right around here. But you know what? See here? So would 12 other people, right? See, here's 11 people. This is what's going to form a temporary floor. But you see they're getting chewed up, right? So that means people are selling. Their buys are getting filled, so that means that's not good. Now you got to look at the next good support. It's going to be this guy, and he's getting chewed up. You don't want to see that. When you see these lower guys being chewed up, it's probably going the wrong way. And gasoline, though, is a crazy thing to buy. You know, when you get in gasoline, you watch it. It goes up and down, but you got to realize these are thousandths of a cent. These aren't hundredths of a cent. These are thousandths of a cent. So it looks like it's violent, but it's really not. In fact, oh no, they both like that. Yeah. I mean, frankly, you know, you're looking up and down. We're looking at these penny ranges, but meanwhile, this chart's showing you 1,000th of a penny move. So of course, it's going to budge up and down really fast. But anyway, so my point being, let's say if I want to get to 12.30, then I take something that's going to be 8 points below, which would be 1.322, which would be way down here. So where these 14 guys are buying, that's where I would like to be buying. But the problem is, if it gets down there and they get chewed up, I don't really want to. I'm not going to have the faith to buy it. So it's unrealistic that I'll buy it. I'll probably just have to stick out with the one that we have. But you know, on a larger scale, these are $400 per contract. So if this thing goes down 2.5 cents on me, down to 130, it'll cost me $1,000. All right, but I don't mind myself. I don't mind adding another one or maybe two down here at 130 if it's still between now and tomorrow morning, because I think that there will be a bounce after that into the weekend, and I strongly believe that. So I would have conviction. So now if I add another one at 130, then my average will be 132 plus. So my average will be about 131. And that means all I need then is to bounce back to 131, and I can get back even and have my one left at 131. So that's how I'm looking at this now. I could sleep on this. This one entry here, I could easily go to sleep on and not worry about it. So I'm not playing for this little teeny move down. So unless it takes a pretty good move down, I'm not going to worry about it right now. What else is going on? Let's see if there's any other interesting plays. So that's my main play right now, is we're long one gasoline contract at 13238. Now, oil. I would play oil long down here at 44.50 with tight stops at 44.50. Well, let's do that. At least I think it's worth showing you how to do it. I wish the dollar was not higher, though. That's kind of annoying. But oil is going to be, oh, stupid. Oh my God, did I just close it? No. Oil is going to be an easier example because it's not so fast. Okay, so I want to average. I want to be at 44.50 to 44.60. All right. Now normally I'd be patient, but you see how there's 100 here and 100 here and 100 here, and there's no hundreds over here except for this guy. So generally, there seems to be a lot of buyers for oil. So I'm going to watch this for a bit and see which way it's ticking. Who's getting eroded? Ah, that was quick. So you see, it's heading down. So at the moment, I'm not really inclined to jump in for no reason. But I certainly think 44.50 should hold. Now we got 32 and 50, 36 and 54, 28.59. He's getting bigger. Up 29. He dropped fast. Somebody's selling. 38.41. 36.40. Oh, up. Damn it. Oh, look at that though. Look what happened. Somebody flooded in with 100 and something orders. All right, so now, I'm gonna go ahead and let's assume it's got a legitimate reason. So now I capitulated and I went in at 44.65, long on one. Now, I would like to be at 44.60 or lower. That's what I was waiting for here, and I didn't get it. So now, if I'm going to add one, I'm going to add one at 44.55. That'll give me two at an average of 44.60. And I don't believe we're going to go below 44.50. If we do go below 44.50, I'll probably get out, and then I'll have lost two at 60, so that'd be $200. So by entering this, I'm risking two. So you have to know what you're doing. I'm entering here, I'm risking $200. Okay? If oil goes down here, I'm going to add another one. I'm going to. So that's already my plan. So if oil goes down here, I'm going to add another one. And if it goes further down, my average will cost me $200. Okay? Now, what's my upside? My upside better be more than $200. You don't make even plays. You always want to make plays where the odds are in your favor. So what's my upside I'm looking at? I'm expecting it to go back to 45. If it goes back to 45, that's at least that's a $350 move up on one contract. But if there's one contract, then I was never at risk, so that's fine. So if it goes up, and I've only got one contract, that means I never even had to sweat this thing because it never even went below where I thought. If it goes down to 2 and I get my price and it pops back up, I can make at this spot instead of $350, I would make $700. So my potential gain on this trade is between $350 and $700, and I'm risking at most $200. So that's a good risk reward, and you have to assume the odds of 50-50 you're going to be wrong. But if you consistently take trades that have a positive risk-reward ratio, then you can be right half the time and still make some good money. All right, but this is what I wanted. It's kind of boring, but I want to show you, like, this is the discipline of the trade. I'm not doing anything unless this gets to 55. And at 55, I'm going to most likely add another one. Okay, now, I should be watching gasoline. Here's gasoline. It's doing okay. I'm positive on my gasoline trade. I should be watching Brent. And I should be watching the dollar. If the dollar is stronger, it's going to put pressure on oil. If the dollar is weaker, it's going to be good for oil. All right, I'm also watching the time. Remember, 2:30 is when the NYMEX closes. So if there's going to be a rally, I would assume it would be into the 2:30 close. We're early in the contract cycle. Okay, oil contracts expire 3 business days before the 25th. So we're past the old cycle, and we're very early in the new cycle. So 3 business days before the 25th of September is, let's see. Okay, so 1 business day, 2 business days, 3 business days. So basically the 21st of September is when these contracts are going to expire. So we have lots of time. We have 3 weeks. So there's no pressure on these guys to get out of their contracts or do anything special. So we assume that they have time for shenanigans on a Friday, especially getting into a holiday weekend. It's not Friday yet, it's Wednesday. And the gasoline has such a good demand story, I'm not going to worry about it. I mean, until the holiday weekend, you can always do it. And look how far this is. It's all this distance, but it's only $80. $100 now. So this trade's in good shape. And this one's down 40. I'm much more confident in the gasoline trade than I am in the oil trade, but I wanted to show you in the oil trade how we scale in. So the point of this trade is I just wanted to show you how you go from a 45.65 entry to here. We'll add one unless it looks really bad. So unless the dollar is going up and gasoline's going down, but gasoline's going up, so if oil comes down, I consider it an opportunity. So the dollar's down, gasoline's up, and oil, if it goes down, it seems to be a mistake to me. And it seems to be a mistake to that guy too. And now it's 107 here. But see, here's a big seller. There's a guy over here selling a lot of contracts. Look at that, 100, 103, 84. Somebody's dumping out. But when that guy's gone, maybe there's nobody else. That's how that happens a lot of times too. That's why you see these patterns on a chart. You see flat, 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 because there could be a big seller who every time it's at a certain level they sell, but then when that seller finally is exhausted and sells everything, there's nobody else selling and it goes right up. That's why you see those wacky patterns sometimes. All right, so now we're back to where we started. All right, so forget it. Nothing to see here. We'll move along for a minute. Answer a few questions. All right. Do you think Twitter will eventually be taken over? I hope so, because they're terrible at their job. No, look, they're finally doing what they're supposed to do. I've been saying for ages that Twitter is just bad at monetizing their revenue stream. They finally made a couple of moves to do a little bit better, and it's already paying off for them. So it's making them a more attractive takeover target. But honestly, they've got plenty of money. They're not worried, and they don't need to be taken over. So it would have to be a hostile takeover because I don't think anybody inside is looking to buy them. But I think Twitter will certainly continue to climb in value because it's a valuable company. You can't have that many people using something. They've been idiots. But you can't have that many people using something and still fall apart because Yahoo managed it. Yahoo had hundreds of millions of people using it before anybody else did, before Google, before anybody. They had the incredible amount of eyeballs, and they blew it. So you can completely screw up a company like that. So it's not out of the question, but I think these guys, if they come even close to monetizing the way Facebook monetizes, they could double up from here easily. And so if I were them, I wouldn't sell for anything less than like the 40s. So if they're going to take a cash offer, it's going to be a whopping cash offer from somebody. It has to be somebody big. And then you've got monopoly and things. Who's going to buy them? Google can't buy them because everybody freak out. Microsoft can't buy them. Maybe a phone company or something like that might do it, but it's just, I don't know. The cultures is so different. How do you put a phone company with Twitter? And the people in Twitter and all these guys in T-shirts and whatever and making tons of money compared to all the phone people. There's employees at Twitter making more than the CEO of Verizon. So you got to be careful about that too. It's not, when you acquire somebody, there's more than just a consideration of acquiring a company. I've done that. When I've acquired companies before, and you got to look at the salaries of the people you're acquiring because it's going to piss off your people. So, if my company's strong enough to acquire other companies, but by acquiring another company, I'm going to piss off everybody in my company because, our acquisition makes them all rich. And then not only do they become rich and get these incredible cash outs with our money, but then they're getting salaries that are double, triple what my people are making, and my people start going, what the hell? They've been sitting there busting their ass for 10 and 20 years, and I've taken this big pile of cash from the fruits of their labor, and I'm buying this .com company and giving them all the money these guys work for in my company. That's a terrible thing to do to your people. So it's not as easy as you think. Okay, it's not like, that's why you don't see that. That's why acquisitions are kind of few and far between on the whole. Okay, because there's a lot to be taken into consideration. Can we look at ES? Didn't we look at ES already? Look at the S&P. All right, well, I'm going to look at this here. Futures. There, ES. What about it? That's the monthly view. There you go. That's a more realistic view. Okay. So, it's too high. I know we were talking about this already. Anyway, there's ES. What disadvantages trading futures into what? What are the disadvantages of trading futures way into the future like we do with options? There's no disadvantage. You're paying a premium for the longer dated contract. So, what's your reason? Unless you have a very, I personally do not play the future that way. Now, there's perfectly good reasons to do it. If I'm a farmer and I'm selling my crops next year, and let's say I'm selling wheat, right? And my wheat is $2 a bushel now, and that price makes me 25%. And I'm worried that wheat will go down, so I might sell my futures into next year, because that way I lock in a price of $2 for next year. So I've got a perfectly good reason. I don't have the wheat now, but I will have the wheat next year, but I don't know what the price is going to be. So there's a legitimate reason for having a long contract. If you're speculating, though, I'm not sure how specific your speculation is, that oil's going to go up or down on this and that day, that you're willing to pay a premium for the longer contract. Are you not going to see if you're going to take the if you're going to take this September? Well, wait, you're saying September 17th. I don't know why you would say that. COU is gone. That's a dead contract. We're in the B's now. So let's say you took a Z contract, which would be December. What's the point? Are you not going to sell it between now and next week? So the only reason I would take a December contract is if I absolutely was gung-ho certain that I wasn't going to be selling it. Like natural gas. I took natural gas contracts in February. I bought summer natural gas contracts because I felt that it was unlikely we would get a very big run-up until later in the summer. But in case we did, I wanted to have the contract, but I didn't really expect I would be able to would be using it. As it turned out, we got a huge run-up. I did well, but I would have done better with the shorter-term contract because the longer-term contract didn't go up as much as the shorter-term contract. So you have to have very specific reasons that you're doing it, not just, I don't know, I'm not sure what the point would be. So the disadvantage is that you're just paying a premium to be locked into a longer time frame. The whole point of the futures to me is that you're not paying a premium, that you're paying exactly what it costs, and you get in and you get out and you're done. Can you talk about PSO, please, how to play it? PSO is a stock that we have. It's Pearson. They've had some troubles. They're just reorganizing, though, and changing the way they do things. We picked them up because they dropped, not after they dropped. And they haven't really gone anywhere since. They've been pretty dead money here. They do pay a nice premium. There's no real reason to say they're not going to keep paying the premium. So how would I play it? I would, you want the dividend, because the dividend is, come on, Yahoo. I think I don't like it about Yahoo Finance. It's a little bit hard to get back to. It used to default to the main page, but it doesn't anymore. All right, here we go. So the dividend is 48 cents. Okay, we have Pearson. I mean, we did pay more than that. We've had it for more than a month, haven't we? In our long-term portfolio, so it was 119 yesterday. That's not good. Okay, we lost 2%. We lost 2%. So we got to be careful about how much hedging we have. I was looking at. We haven't gotten around to it yet. But I'm a little inclined to either hedge more or cash some of these out. Pearson, right? PSO. Oh. Where did we? I thought we had it in the LTP. Or maybe I didn't enter it. Can't be in the 5% portfolio, can it? That would be weird. No. Okay, you got me. All right, well, clean slate then. Anyway, so they pay, getting back, a 48-cent dividend. We're going to look at the historical data, and we're going to look at, here you go. Oh, look, they just paid it. Damn it. 23.8. Oh, no. I know what I did. I looked in the wrong place. I know it's in the LTP. So I remember we collected the dividend. There they are. I feel better. Oh, I'm sorry. We had them back in June. We bought them at $12.25. I'm sorry. We bought them at $12.25, but we sold the $12.50 puts and calls. So we weren't expecting them to move anything. We were right on the money. We sold these puts and calls for $2.30. So our net was $10,995. Our net was $995. That's why we're not worried about it. So our net was $995. They're at $11.33. Really not a problem for us. Plus, we just collected that nice dividend, which was 23 cents, right? So we got that dividend, and how often do they pay them? Oh, and here they paid another dividend. April they paid 40 something. So it looks like they pay. It looks like they pay semi-annually. No, I don't know what they're doing. They're weird. Okay, so here you can go. Time period show dividends only. Apply that. Oh, that's not very useful, is it? So we don't know if they're paying this quarterly or what they're doing, but apparently it seems to be they apparently paid a full year dividend here, and now they're moving to like a semi-annual dividend. So I would assume that, let's assume that it is going to be 40 something a year. So at $11, you get a 40-cent dividend. You don't want to blow that off. So I would want to own the company, and I would want to buy the stock. So like I said, in our portfolio, we chose to buy the stock and sell puts and calls. Now, they're not in the same place. See, that's the thing. You get a better price. The reason I pull the trigger at $12.25 is because when you're at the money, you get better premiums. Oh, how's this stuff doing? Okay, oil's ticking up a little bit. Gasoline looking good. Look at that. How much? $2.50. All right. Who else makes you $200? See, a lot of people can be boring and talk for an hour for no reason, but at least I pay you. At least you can make money while you're listening to me talk. All right, so let's see. Oh, yeah, we're going to look at that. So if we look at the pricing now, the problem is you're between strikes, and if you're between strikes, it's not generally a good time to enter. TSO. See, now you can get March, though. Ugh, nobody's trading it yet. Well, somebody did, 165. Okay, so you're at 1133. Here's the problem. If you sell these Marches for 165, you're going to get called away because 165 is lower than the dividend. But if they don't pay the dividend until April, that's not really an issue, so I would. So let's say you buy the stock for 1133. You sell the Marches for 165. So that's going to net you, I don't know. Ugh. Math. Why math? So 1133 minus 165 is 968, right? Then you also sell, I would sell these. I would still sell these. What are these, $1.50? $1.60, very nice, okay. Minus $1.60. So by selling the by selling the $10 calls and the $12.50 puts, you're dropping your net cash to $808. Now, either you're going to get called away at $12.50 with a 50% profit plus if they pay a dividend. I don't think there'll be a dividend between now and April though. But you get called away at if you get called away at $12.50, you're going to make 50% on your money by March. Now, if you don't get called away, if it's below $12.50, you'll be assigned. So then it's going to be $808 plus $12.50 divided by 2 is $1029. All right, so whatever amount you're going to go into now, you have to assume that you'll end up owning double that amount. You'll be assigned another round, and you'll end up owning 2x at $1029. But 10 is a good number because then you can sell the 10 puts and calls again. And if you collect another $2 for the 10 puts and calls, you'll drop your net to $8.9. Now it'll be 4x, but the worst case is you'll be in at $9, which is a very significant discount from here. So that's how I play it. I would go in with one quarter of the amount that you ultimately want to own is what you would buy now in the stock. Then you would sell the puts and calls, the $10 calls and $12.50 puts. And then in the next round, if it's assigned to you, if it's called away, you make your 50% and you're done. If it's assigned to you, you do it again. And you sell, but this time because you have a net of 10, you sell the $10 puts and calls. So at the same strike, collect another $2, you've dropped your net to 8, and then your worst case is you're going to get assigned again at 10, which means you'll have 4x at 9. So you'll end up owning 4. So your total that you own is 4 times 9 of whatever amount you're going to be buying. So if you could afford to buy, let's say 4 times 9 is what, 36? So if you could afford to buy 36,000 worth of stock, that would be 4,000 shares, right? So you would start off with 1,000 shares at 11.33, and then do the sale that brings you down to $8. So it costs you $8,000 to start with as your first round. In your second round, if you get assigned to 1250, you're going to spend another 12,500. So then you're in for 20, and you have 2,000 shares. Then the next round, you would sell another puts and calls for 2, and then finally you will get assigned another 2,000 shares, and you'd be at 9. So whatever the amount is you ultimately want to get, that's how you sort of initiate the trade. You have to work it backwards from there. Make sense? Hope so. All right, so the index is all bounced, and all they're doing is bouncing. When you see these little things, then you can go back and calculate what the bounce would have been. So we're from 1250 here to 1230, so that's 20 points. All right, and if you have a 20-point drop, obviously you're going to have a 4-point weak bounce and an 8-point strong bounce. So 1, 2, 3, 8 is a strong bounce. Here's your weak bounce line, 1, 2, 3, 4. See the weak bounce? So weak bounce, strong bounce, and if it fails a strong bounce, though, then you're going to test the weak bounce line. Now, if it fails a strong bounce on the first attempt, holds the weak bounce line, and goes back to the strong bounce, that's bullish. But if it fails the strong bounce here and fails the weak bounce, that means that this line's probably going to fail. And really the best way to think about it like it's physics. Think about it like it's a ball bouncing down, like you're bouncing a ball. Okay, if a ball bounces, and it bounces one time, and the next time it bounces less, it's not going to suddenly bounce back up higher. It means that there's nothing, it means that the physics, the kinetic energy has disappeared. And so without a catalyst, without more energy being pushed into it, it's going to continue to just weaken. Oh, wow, look at more. Okay, fantastic. How are we doing? 221. So the NYMEX is coming to a close at 235. So this is a great time for us to turn our attention back to our futures trade. And how are we doing? Well, oil, not so good. Oil's only up $10. My gasoline, though, is up $300 on the one contract. Not bad, huh? How's that, kid? 320. 323, 344. Oh, you gotta love it. All right. So at this point, though, I really kind of want to stop at 300 or 250. I'm not going to take a chance now. I understand that I wanted to make this huge amount of money, but I made this much money so fast. Why would I not take it off the table? I got this oil trade. I can let that one run if I'm going to let something run. But now, if it can't hold like 330, 340, you got to start setting stops at this point. Because we haven't been doing this for an hour. I'm making $300, 350, 360. So now I'd want to, pretty much set a stop maybe at 320, 315. Okay, see now it's going even up higher. I raised my stop to 320 now. I'm going to just follow it along until the NYMEX closes and see what happens. So now my stop is 320, and it's not a hard stop. I'm just holding my finger there just in case. And I want to raise it to 325, but I'm not going to unless I really have a reason. Now we're at 325. I literally have my finger on the trigger to sell this. Up, and there it goes. I'm selling. Yeah, 335. Because I just watched it. I just watched it lose its momentum. And if that one's failing, why should I hold the oil? So I'm going to get out of the oil. And now I'm done. So I locked in 60, and I locked in 335. So that's 395 we made in what, an hour's worth of work? This stuff isn't hard, guys. All right, so it didn't. So in other words, coming into the NYMEX close, I expected a nice run up. I'm not getting it. The dollar is still pretty strong. Brent is still not over 47, and I see oil and gas weakening at the same time. So I get out. And now what was our exit number? Our exit number is 325, which is up here. Or 320. Where did we exit? 320, 325, whatever. So now, though, I really don't want to mess around unless we get over this line, 133.66. That's way up, so I'm not going to worry about that. All right, and I don't mind being wrong. I made my money. I made 335 here and 60 there, 395. So it's fine. If I don't make all the money, it's okay because I just want to be sure to lock in. Now I'm annoyed. But I just want to be sure to lock in the gain. Now, if I had two contracts, I would have had one left here, but it never went down enough for us to have two contracts. And the thing is, especially if you don't know why it's moving, look, see, now Brent went over 40. Now Brent went over 47. If he hadn't done that before, it could have been more bullish. So now let's say if it goes back to 325, we could take another poke. So I'm thinking about it. Oh, look how fast it went down, though. Aha! Oh, I'm so glad we got out. Look at that. See? Right, you can't change your mind. You can't change your mind. I still would like to get back in, but it's crazy movement right now. Holy crap. Whoa, what is going on? Oh, he failed 47. Nope, see, that's a bad sign. He failed 47. He's not moving the dollar, but Brent failed 47. He's barely up there. Wow, this thing is all over the place. And don't forget, we wanted 132.50, so we're nowhere near where we wanted to be in. Whoa, collapse, see? All right, so that was good. So even though it poked over after I sold it, it still turned out we made a pretty good exit. Or at least we saved ourselves a little headache. Frankly, if you just wait 10 seconds, you can get any price you want around here. Oh, and notice all those heavy numbers are gone, right? This is why it's so volatile. There's no 100 blocks of anything now. So things are just flying up and down because there's no major buyers or sellers in participating right now. The volume's lightening up tremendously. Before, there were like solid blocks of 100 here and 100 there, and that was keeping everything fairly steady. Now it's just flying. Holy crap. Whoa. Wow, you want to make them lose money fast. There's not a faster game in the world than this. Oh, look at that. Come on, baby. Back to 325. I need 40 more down and we can play again. But no, way back up here. And we're chasing this thing all day. See, he's at 47, 469. He just flew back up. Crazy. But that's another thing, if you don't know why something's happening, don't play. We don't know why it's going up and down. It's probably just people squaring off their positions into the close. You got 7 more minutes into the close. I really do still think we're going to get back up to here. That's 3.5. But if I think it's going to go up to 3.5, then it should certainly go over this line at 3.3. Damn, what is that? 3.36. So 3.36 is way up here. So once it's over this green line, then I feel pretty. I could take that and make a stop at 3.35. But that doesn't make this a good entry because I don't know that we're going to get over that green line. That could be where it gets rejected. And so far it has been rejected there. But once we're over that line, then we have a very good chance of getting up to this line. And that line is a penny and a half away, which is like $600. So there's a bigger move above this line than the move we just took advantage of. But you got to be patient, and it's either going to come or it's not going to come. And unfortunately, that's the problem. The webinars are kind of boring, like we're watching wait for something to happen. But if you're going to do it properly, that's how you do it. Sometimes I make these entries where I'm like cowboying it to get in, but that's only because time constraint wise, I want to try to show you what we do. But the proper thing to do is what I just did: is get out, make your money, get out, and then don't rush back in. Don't say, "Oh, I got out, now I should gamble again." No, you got out, you got lucky. Leave the casino, unless there's another really good setup. Remember, we wanted 1325, so that's what we got. We got our target. Now I want over 1336, and if we don't get that, I'm not playing again. Because if he can't make 1336, how the hell is he going to make 135? Yeah, I literally need him to go up 12 points from where he just was. 12 1,000. So if he can't make 12 1,000, how is he going to make a 1,500 1,000? So it's just not likely, is it? So I think oil's good to 45, but now I'm also looking at that, because 44.75 to 45 is only $250. So there's more money in gasoline, and I feel better about buying gasoline than I do about oil because of the weekend. I think there's more reason for gasoline to go up than there is for oil to go up. So I would buy 1325. I could see taking an entry. We're almost there. 1329, 1327, 1325. Here's my buy. Oh, too quick. Oh, that's why we don't pull the trigger immediately. 1325. 12. All right, I guess I better buy it if it comes back again. Damn it. How long we got? We got 3 minutes to go on the NYMEX. The dollar is still sitting around doing nothing. How are the indexes doing? Let's take a look. Indexes are weakening, not a good sign. Oil, gas, natural gas, back up again. Nikkei, Nikkei, right back to where we like short. Okay, short the. Well, I'm not going to short the Nikkei again if the dollar's going up, though. The dollar's over 96, I don't really want to short the Nikkei. Gold is flat, silver is flat, Brent is way down here. I think it's time for an OPEC rumor, don't you? 133, 132. Come on, baby. Wow, it seems so far away now. It's right there. What do you think? Should we do it? Nah. I really want 1325. Just out of principle. Oh, not 1325. What am I talking about? All right. It looks like probably the thing is, what's going to happen when the NYMEX closes in a minute and 30 seconds? Maybe we should wait and see. Let's wait and see. Let's be patient. I'm going to be so chill, and we'll see if there's any questions. All right. So we have a profit target for RB. Yeah. If I make a penny in gasoline, I'm so thrilled. Do you expect to see any? It's $420 per contract, a penny. Do you expect to see any kind of pop in Apple with September 7th product announcement? It depends what they announce, but probably it's going to be another one of those ordinary product announcements, and people are going to say, so what, blah, blah. I don't really see them. I don't see any big pops in Apple's future, even if they have good earnings. I think 120 at the most, which isn't that far up from here. So, I don't see much more than 10% upside into the end of the year for them. Next year, though, after a series of strong reports, if they have it, with a brand new, super new kind of phone coming out next year and some other stuff, I think then you're going to see some real good movement. But this year, I don't expect a lot out of Apple. Plus, I think they'll move down with the market. I still love them, though, and still would rather, if I had to buy one stock, it would still be Apple. But I don't expect any big pop. Coffee, by the way, continues to rise. Yes, coffee, fantastic. Coffee is the best commodity right now, is coffee. There may be worldwide coffee shortages due to global warming. So that's a nice thing to get into. It's tricky with the contract. There's one you might want to have a long-term contract, because the trend into the next year of coffee is probably a rising trend. We'll take a look at that in a minute, in fact. Oh, still hanging out. All right, there's the bell of an IMAX. That's it. This is where they're officially closing. So we have 133 and 147, and 44.7 is it. So here's my thing. If I hold this overnight at 133, then if it drops to 130, my average will be 1315. Can I live with that? I think I can. Now so what's likely to happen overnight? We know the report showed a little draw in gasoline, but we also know the draw in gasoline was bullshit. It wasn't anything to do with demand. It's only because the gas stations are filling up their tanks. It has nothing to do with consumers demanding gasoline. There'll be the anticipation of demand into the weekend that we have a good chance tomorrow or Friday that there'll be some stories that people will get excited about gas being drawn down over the weekend, and that'll keep prices up. And so hopefully we should get a run back to 135, which is right. Here's 134. That's easy, obviously. 135 would be nice because that would be $600 per contract gained. But then what am I risking here? I'm risking going from 133 to 130, which is a big loss. That's my risk of loss here is bigger than my gain. So it's not really a good play, and I'm going to have to say no. So unless I'm lucky and gasoline is back down at 132, I'm not going to play. End of story. And that's a very important discipline. You have to do that. You have to run through the logic and say, well, how much can I make? And so if it goes back to 135, I make $600. But I'm risking $1,200 if it goes down to 130. And those are the two things I think are possible. I think we could go down to 130 or we could go up to 135. And since we're 133, this is a dumbass spot to enter along, right? My conviction. Now, that doesn't mean it's a coin flip, though. It doesn't mean you say, well, why don't you go short there? I don't go short because I think gasoline will go up. My conviction is that it should go up. But my risk-reward on a conviction trade going long is not good enough to make the entry. End of story. So the trade's dead. So, and that is probably one of the best futures lessons I can teach you is not to play. You've got to look at them, you've got to follow through with the logic, you've got to decide whether or not the risk is worth the reward, and you have to have the discipline to stop out and take that quick loss if you're wrong. Coffee. Oh yeah, let's look at coffee. Okay. You have to take my word for it. I'm not going to go dig up the articles, but trust me, if you look it up, you will see that global warming is causing a big problem for coffee people. So we've gotten this bump already from June to August because every time they get a report, it does not look good. But in the grand scheme, this looks good, right? This is a nice run. What is that, like 10% or so, right? So about 10% up over the course of the summer. But if you look at the long term, we're nowhere, man. Now, this was caused by Starbucks. Starbucks and Green Mountain Coffee and blah, 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 okay? They started demanding more stuff than there was. And everybody was opening a coffee store. It wasn't real demand. It was the demand from all these places opening up coffee shops. Think about how much coffee there is in Starbucks, right? Think about how many thousands and thousands and thousands of cups are in a Starbucks worth of coffee. And think about all the supermarkets that have gourmet coffee sections now, that have tens of thousands of cups of coffee. Like I go to the Fairway Market I go to has barrels of coffee beans, and I mean, I'm trying to think how big it is. At least 40. They got to have at least 40 different barrels filled with coffee. It's definitely enough coffee to keep my whole town awake for a week. So imagine how much coffee, adding all these sections to all these grocery stores and all these gourmet shops and all these coffee places that opened up. It's not that people consume the coffee. It's that they open up all these stores that have to have bins of coffee stored. It's like when people buy gold ETFs, right? The gold ETF, because you bought the gold ETF people have to go out and buy gold on the market. You're thinking that gold will go up causes gold to go up because you're out there buying it. This is what the coffee people did. They bought up the supply of coffee. And the growers were not ready. Now, what happened then, though, is because the price of coffee went to $3.50, all of a sudden, every Juan Valdez wannabe starts planting coffee because it's like such an incredible cash crop. And what happens then? Well, it turns out that this demand, once these guys fill all their bins, now they only have to maintain it, and they don't need as much coffee as everybody thought. This was false demand, just like China when they fill their storage of oil, right? It's false demand, because once it's full, they don't need it anymore. And then all these guys start producing twice as much coffee as they used to, but now the demand goes back down, and all of a sudden the price of coffee completely collapses. That's why markets cycle like that. Big spike, everybody starts making coffee, big drop. Flat, demand picks up for whatever reason, but it's a false demand. It's not a long-term demand change. So then the price spikes up and drops back down because supply doubles up. Now, probably equilibrium is somewhere down here, though, so in any case, I would think coffee would be good for a run. And I said early in the week, I said once we get over 145, we'll probably, no, I'm sorry, I said 150. Once we get over 150, we're in very good shape for a run up. But I like coffee here a lot. Now, there's an ETF for coffee called Joe. So let's take a look at those guys. I don't think they have long-dated options, though. Let's take a look. We've played them before. No, they only go to March, unfortunately. But you can pick up Joe, which is the coffee contracts, the coffee ETF, and Joe is at $21.70, and the $20 calls are $250, $328 for the 19s. It's a lot of premium. See, if you're paying $3.20, if you're paying $3.30 for the 19s, it means you're paying $22.30. All right, that's not so bad. That's 50 cents. All right, so 50 cents premium I can live with. How much premium is it if you buy the 20s? Well, if you buy it for $2.50, you're paying $22.50, and that's 80 cents a premium. If you buy the 21s, it's also that means it's $2.50. That means this $2.50 is probably wrong. Somewhere between, all right, so let's say that this is $1, so this should be $2.75. So this is 75, 21.75 plus 23.75. Wow, really? That's a completely unacceptable amount of premium. Here you're paying $23.75. You're paying $2 in premium here. So on the 20s I'm losing my mind. This is $2.75. $22.75 here is $1 premium. This one is close to $2 in premium. That's crazy. This one is $22.30. That's only 70, 60 cents in premium. So this is where I start. I go for the 19th. So the March 19th selling. Now you want to sell the most premium, right? So the 22s are, this is like $2.50 in premium. Okay, that's great. So the 19-22 spread. So you buy these for $3.30. You sell these for $190, let's say, $185. No, $190. So $3.30 minus $190 is $1.40. So now you're buying the spread. It's a $3 spread, 19-22 spread for $1.40. That means at 22, which is where we are now. We're almost at 22. you make $1.60 profit. You make 100% profit if coffee holds where it is now, just a tiny bit higher. Now, against that, you can sell the $20 puts. That's a bit below where we are now. You sell those for $1.10. So now you've net 30 cents on the spread. You have a $3 spread that you net into for 30 cents. All right, I really like this trade, so let's officially add this to the short-term portfolio. We can do 50 of these in the short-term portfolio. Not 50, but let's sell 25, half as many of the puts. So we'll end up paying like 60 cents or 70 cents for the spread. We're going to sell half as many puts. So we'll sell 25 puts. Let's say 20 puts. We'll sell 20 puts and buy 50 long calls of this. And it's a 19-22 spread. In the options opportunity portfolio, we'll sell 5 puts and we'll buy 10 longs. Maybe 10, maybe 15. I'll see. We'll buy 10 or 15 longs. We'll see what it looks like. All right, so that's the trade I would make for coffee for sure. And you could mess around with the futures, but frankly, my attitude about that is I don't have time to watch it. So I'm not going to play. I very much like the coffee futures. I think they're a great play from here. But I'm not going to play it because I would then have to add it, and I'd have to watch it, and I would have to figure out what I want to chart it against, and so on and so forth. So it's irresponsible of me to pretend I'm going to pay good attention to the coffee futures. So I'd rather just pick up Joe in my portfolio and use that. So that's going to be an official trade. We'll send that out, and we got time, so we'll be able to do it. I agree with John Casey, right. Do you think COT commercial hedgers is getting short around 150 is a sign of a top in coffee? No, I think they're idiots. Look, short-term top, yeah, I think there's going to be resistance at 150. That's why I said once we're over 150, it's going to be a great spot. So yeah, of course there'll be resistance, but I think that also don't forget these guys have been down for so long. The commercial hedgers are actually selling coffee. You know, these are guys who actually represent the coffee producers. So the commercial hedgers want to lock in $1.50 because it's been years. It's been almost 2 years since they've gotten 150 reliably. Last time they took a chance at 150 and they blew it and it went back down. So this year, the coffee guys are being like, you better lock in 150. Just like Mexico. Mexico just locked in $1.46 for their oil. I mean, $1.46, $46 for their oil. Mexico just sold 1 billion barrels of oil for $46 as a futures contract. They will produce, so now they have to produce the oil, but they've already pre-sold it for $46. Because they're like, $46, we'll take it. That's what the coffee guys are doing. So when you see these commercial hedges after a depressed market, it doesn't mean that people are short. It just means that the producers want to get some money. Gogo is buying active. Is Gogo still play? Is it still a good play? I mean, I still like them, but I think they've gone pretty. They're so far. I think they're so far from where we went in. Yeah. See, I hate when people ask me that. We bought it down here, and now it's up here, so it's like 50% higher than we bought it. So do I still like it? Yeah, I think they're great. I think they're going to be higher, but. I think if I was going to play it now, how about this? Why don't you sell a put? That's the best way to go. They have long-term options, don't they? Yeah, they go out to 2018. So, they're at 1243. So not 10. Absolutely $10. I would like to buy them again. $10 is a good 20-something percent. Is a 20% discount from here. So yes, at $10 I would love them, right? So. Oh, look at this. Forget 10. Oh, you can't get $1.90. It's not the right price. See, these prices are not even right. Because, here, look, the bid is 120. The ask is 165. There's no way you can get 190. All right, so let's say that this is close to this. So 120, 165. So let's say it's 150. If that's 150, and this is $2 higher, then probably be $1. So let's say $3. So realistically, you should be able to get $3 for selling the $10 puts. I would do that because you're netting into the stock for 7. And all the stock has to do is hold 10, and you're going to make $3. So that's how I would initiate my go-go position. I wouldn't mess around with anything else. I would just sell those $10 puts for $3 because you're going to get $3 right in your pocket. So you do that, and then watch what happens. You sell them. Sell. In fact, let's do that right here. So I'm going to show you something funny because right now you see the spread. This is a good time for a lesson, so why don't we do it? The spread is $1.55, $4. I'm saying to myself, well, look, the $8 ones are clearly between 120 and 165, so they got to be about 150. So the 10s, I would think I can get at least $2.50, maybe $3 for. All right, for the $10 put. So now let's take a look, and we're going to try and make an offer. So I'm going to sell, and we'll sell 10 of them. What the heck? Because we'll send 10 contracts. I'm going to sell it not for $1.55 though. I want $3. $3, okay? And I'm going to put in my order. Look at that. You collect $3,000. $550 is your 547. So $550 buying power. So my margin on this is $550, but I collect $3,000 up front, and I'll make $3,000, 6 times my margin. And all I'm doing is promising to buy go-go for net $7. And I will make $3,000 against $545 in margin. So of course I want to do that. So now I put my order in. Nobody took it right away, so we'll see what happens. So I'm now I'm hoping go-go goes down a little bit. And I'll leave that in good to cancel, and we'll see if it fills, that's all. Nope. Go-go went up by a junkie put. Well, what's a junkie put? I mean, I was going to buy the, I don't know what a junkie put is, but I'm selling the puts because I'm happy to own it at that price. If it go lower at $20, we're happy to own go-go. Happy to own go-go too at the other price. We're happy to own coffee for the long term because we think that there's a long-term warming trend that's going to damage the coffee crops. Now, it won't long-term damage, long-term though, it won't, because what's going to happen is other areas that don't currently grow coffee will say, hey, you know what, we can grow coffee now. Nobody's ever had Greek coffee before, right? Greece doesn't grow coffee. All of a sudden, Greece is going to have a coffee climate. All of a sudden, there'll be more Mexican coffee growing. All of a sudden, there's going to be other places start growing coffee. Florida coffee. Who knows where it'll be profitable to grow coffee as the band where coffee is. See, that's the thing. The temperatures warm up, and some places become unsuitable for coffee, but that temperature band moves somewhere, right? The band that makes the good coffee growing. But it takes a while before the soil changes, and the trees change, and the leaves change, and the wind changes. Once the conditions are right, you don't know where it's going to be right, but it's going to occur to somebody in some country where they can no longer grow whatever crap they were trying to grow before because of the temperature change. They'll say, hey, wait, this is a good temperature for coffee. And they'll start growing coffee. That's how farming works. But it's just such a long, drawn-out play that you don't think of it that way. Oh, coffee's, yeah, I like it. It's from the Dominican Republic, which is that's a good crop for them, too. That's a great export. So yeah, all these things have to be taken into account when you're making these kind of trades. Oops, not what I meant to do. All right, so oil went back down because basically what that ended up being is that the run up into the close of the NYMEX was kind of bullshitty. And so what we really have here is a failure, a rejection of that line. That I said if they can't get over that, that's sad. Well, they can't get over it. It is sad, and now I really wouldn't play at this point unless they do get over that line. Which is what, 1335, 1336, something like that. So unless they are over that, I don't think it's worth taking the risk for an outside play anymore. And oil, just as bad also. Oil's very weak as well. I like the bet. I really want to take it into the long weekend. If it gets back here at 132, it's worth the risk, but it's not worth the risk at 133, unfortunately. Oh man. I was going to say, but you know what is worth the risk is the Nikkei. So with our last trade, since the Nikkei was kind enough to get close enough to where we like it, what am I doing? Let's just short one Nikkei and see how it goes for next week. So the last trade of the day, and I'm going to sign off after this, is we're going to do the Nikkei. We're going to sell it. It's already made $800 today, so we're in good shape. So if the Nikkei pops up all the way up to here, which is 925, 930, right? At 930, I will average 16.9. Okay, so I'm happy to add another one up here. This is not going to bother me at all if the Nikkei pops. So I'll definitely double down if it gets up here. If it gets up here, I'll probably double down again. Now, if it gets up here and I double down again, it means my average will be 16.950. That's exactly, in fact, that's exactly the strategy we went over today in the morning alert. So we're right back in the exact same place we were in the morning, if I could find it. Okay, it's exactly this strategy. It's right back in play. We're at the same place. Nothing has changed. We have no reason to change our mind, so we're making the exact same play we made this morning. And now we'll see what happens. All right, so we have the coffee trade. We'd like to do gasoline long at 1325 if we get back to that line. If 1325 fails, we're going to get right out, and we're going to hope the 130 gets hit. So very tight stop at 132.5, not a conviction play. But then getting down to 130, we'd have a little more conviction. So we like that one long. We like the coffee trade on Joe, which I'll print up in chat. And we like the Nikkei short at the moment. Okay, and oil, I'm not too wild about the oil long, so I wouldn't count that as being something I want to get into. All right, so thank you guys for coming. It's been fun, and we will do it again next week. Oh, wait, what's this? What am I missing? If the dollar goes to 100, Nikkei goes up. I don't think the dollar's going to 100 tomorrow. I'm not playing Nikkei for weeks. I'm playing Nikkei into tomorrow. All right, guys, thanks. Have a great weekend. Have a great holiday, too.